All right, good afternoon, everybody. Event trader here, Gavin McGuire, and I am being joined by Brett Manning, chart trader. Brett, how are you doing today?
I'm doing fantastic, Gavin. How are you?
Doing good, doing good. And that's good to hear from you. Obviously, you've had an adventurous month, to say the least. Do you want to give a quick update on how the family's doing? I know people are interested out there for you personally and just in general, too, to see what's going on with that.
Well, I can report now that every member of this household is now tested and 100% COVID-19 free. And we are, oh, I just got a B right next to me here. We are also 66%
Hopefully
of
not
the
a murder
household is now
hornet.
carrying antibodies. So, yeah, so
Hopefully,
it's really good.
hopefully not a murder hornet next to you there.
Oh, it could be. Guys, I got another problem. Murder hornet.
Been a pretty adventurous month in the markets too. We've just seen a real steady rise, and we had talked a couple of weeks ago. I guess it's probably been about 3, 4 weeks since we last met, and we were talking a little bit about the V-shaped recovery and the idea that nobody was positioned for it. And we're certainly going to break into that a little bit. But what do you think of the action over the past couple of weeks, Brett, since we've spoken last?
Well, yeah, I mean, I think that it kind of continues to demonstrate this remarkable. Hold on 1 second, Gavin. I need to open something because it's just going to be a murder hornet sitting right next to my head this entire time, and that's a bit distracting. Come on, buddy. Get on out of here. Hopefully you'll take the hint. Um, so yeah, no, I think this conversation we've been having about the market has continually reflected the seeming remarkable disparity between what you see in the tape and on the chart versus what you see from any kind of fundamental data, whether it's economic data or individual corporate results or any kind of forecasts or anything else. And we've come up with this lexicon around that, with the featured terms of depth versus duration, and this kind of game of whether we're going to be able to get past the cause of all of the disruption in a short enough time frame that the policy bridge that we've been building will stretch from one side to the other. And if so, there's the possibility there of a V-shaped recovery. But there don't seem to be a whole lot of people that actually are willing to go out there and predict a V-shaped recovery. And as we're going to cover, most fund managers seem to think there's no chance of a V-shaped recovery, and yet the market continues to behave as it does, and it's put this kind of mystery in front of us. And today really is about trying to explore that mystery and come up with our basic explanations there.
Yeah, exactly. And I mean, like we've heard the term over the last 10 years, the most hated rally of all time. But this
I
this
think it
one might
has
take
to
the
be.
cake.
This has to be.
So let's take the 30,000 foot view first with that and get to the barest of questions, right, Brett? And that would be probably the American Association of Individual Investors, which last Thursday came out with their latest numbers. And then we can kind of peel back the onion from this 30,000 foot view. We had 29% of the people polled were bullish, 26% we'll call it were neutral, and 45% were bearish. Now, to keep that in context of what we'd been seeing, that was actually about a 600 basis point rise on bullish, where on May 14th, the survey was done on May 21st, right before the Thursday, right before the Memorial Day weekend. On May 14th, we stood at 23%, so about a 600 basis point increase on the bull side. Neutral side's been pretty steady over the last month or so, running around that 25% area. And then the bears, that had fallen about 5% from the 50.6 that we were sitting at on May 14th, and was the first time it dipped to be below 50% since April 30th, so the first time in May there.
Can
Um,
I contextualize that with one additional data point?
yeah, certainly.
The one of the things that I've followed for a long time with this indicator is the 5 week moving average of the bull ratio. So if you take out the neutrals and you just take the bulls divided by the bulls plus the bears. So it's the percentage of anybody with a directional opinion that are bullish. And you take a 5-week moving average, and I found that to be really important because that shows that there's an opinion that's festering for a period of time that really gives you a sense of where people are positioned. And that got down to, I think, 25 this week, and that has, or 34, sorry, wherever I have my lower green line drawn. And that's the first time since a period that felt in some ways similar for very different reasons, which was early 2016, when we had a lot of some of the most dramatic and overwhelming bearish sentiment readings in front of Brexit and behind the implosion of the oil space.
Election
we
year
had,
two.
What's that?
Election year two.
Election year two. Good point. But that was the last time that we saw the 5-week moving average of the bull ratio get down that low, and it shows that subset, and I think it's a reasonably representative. It's a small poll, but it's reasonably representative of a certain faction of kind of active non-professional participants in the market. This is the first time that measure has gotten down to that same level since I think somewhere in early February of 2016, which was another one of these, spawning from that and through that period, one of these sort of most hated rallies in front of Brexit, and the market just couldn't seem to break, even though we had all this data suggesting that we had the cycle starting to roll over, and a lot of it was about what we saw happening in oil and industrials, and how they were going to manage to leak onto the books of financials who'd lent money to the commodity side of the market. But that whole side of the market had just completely imploded, and that whole side of the economy had. And a lot of people were likening it to as if the commodity sector was going to play the part of the financials in a redo of the 2008 crisis. And we had a huge amount of bearishness, and that was a very similar feeling rally that came out of that period.
Yeah, and it's funny because it's one of those history doesn't repeat, but it rhymes, right, Brett? Where we're getting once again and energy, although we have seen a nice recovery in energy and oil over the last couple of weeks, which we'll get into. So, that's been a key driver behind this bounce over the last couple of weeks. That's for sure. As we start seeing that get back into play, but as you can see, we've got a pretty bearish sentiment out there, yet we continue to march higher. We've hit our best levels today in the S&P. You got to go back to early March, which would have been right before the big collapse that we saw when panic really kind of ensued in the break of the 200-day moving average at that time. So just a steady run. And with that, Brett, let's take a look at the Bank of America Fund Manager Survey next. And
Can I first interject just a framing statement of sort of this moment in market history? What is the big question for us to deal with? I think that framing moment comes with the idea basically of, so this rally that we've seen, it's this huge and remarkable move over the course of a couple months. Is that something that is conveying information through the pricing function about something like the market skating to where the puck is going to be rather than skating to where the puck is now in terms of economic data? So is that the case, or is it just a crazy, weird anomaly built of just new and odd versions of speculative mania happening because of, and I think that's almost like a consensus narrative that I feel like has started to develop in professional market participant circles, is that what we're seeing right now is really an upshot of a gigantic new crowd of out-of-work 28-year-old service sector people taking their government stimulus checks and putting them into Robinhood accounts and gambling in the stock market. Like, is that the explanation for why we've seen this huge rally in the face of seemingly difficult economic data? Or is there something substantive to it that's telling us something about the future? And, markets attempt to discount the future, in some cases do pretty well at it. Is this the market discounting the future, or is this something where there's just this huge asset mispricing driven by some strange cultural event involved in the market? I think that's kind of the big question that we're looking to shed light on today. And now let's turn to the fund manager survey to try to start that process.
Yeah, and like Brett said, that's the whole point of today's discussion. Who's behind this rally? And so we're going to break it down. First, in the fund managers survey, definitely some of the flow data from Bank of America as well. And then take a look at some of the sentiment data, with in particular look at some of the retail, the ROBO options activity. But first, the fund managers survey. And again, we've talked a lot about the V-shaped recovery, and right now in the latest survey, only 10% of the fund managers surveyed expected to see a V-shaped recovery. 25% think that we're in the midst of a new bull market, and 75 in contrast, 75% expected a U or W shaped recovery. And then finally, 68% believe that this is a bear market rally. Brett, in you're reading the charts, are you leaning in any direction here for
Well, I mean,
starters?
so yeah, like I see. I've started this rally with the game plan of trying to find and bet against the top of it. I have to admit that that bias was there from the beginning. That it was very difficult for me to accept right off the bat that this was going to be just a pure, outright insane historic stock market crash that would then simply instantly transition into a steady bull market rally that would be indefinite. So it was always kind of this bias that's, I think, inescapable, and I think probably explains the way a lot of people feel that you realize there had to be some kind of bounce, but that there was this next big opportunity to short that bounce. I think that was from the end of March, that was impossible for me to not have that at least somewhere in my mind, and I guess part of the process has been me trying to suppress that instinct because it didn't mesh with the sentiment data. And in my experience, so just as a general note about sentiment data, some people look at the world of sentiment data in terms of so there's the smart money and there's the dumb money, and you try to figure out who the dumb money is and bet against them. But the smart money, you want to bet with them, even if it represents a huge consensus. And I usually don't operate that way. That's just a paradigm that I don't generally think in terms of. What I think in terms of is if basically everybody involved in the market seems to all share a particular opinion, and the market starts to be resistant to acting according to that opinion, then usually everybody's going to be wrong and we're going to go exactly the other way. And I don't really think in terms of who's smart and who's dumb. I think that especially in this instance, the people who would seemingly be the smartest money in the market don't really know how this is going to work out anyways. And they maybe even have some baggage in terms of reliance upon a method. Well, in terms of reliance upon a method of analysis that may not be applicable to this current situation. And I think that we've seen a lot of real old-time pros who have had a kind of stammering reaction to what the market is doing right now relative to basic tried and true economic indicators. And, they don't really understand what a viral global pandemic is going to do to the economy, and especially not in a situation where we have unleashed such dramatic and almost obscene policy tools into the mix. So I think that there really isn't any smart money here. And if everybody's all on one side of the market and the market's doing something different, then I have a real hard time trying to participate as part of that crowd. So it's really made me uncomfortable shorting all the way up.
Well, it's funny because we'll get into it later, but when you do the dumb money versus smart money breakdown from the sentiment trader, you got to kind of have to wonder who the smart money is in this situation, because the quote unquote dumb money has been making a lot of money.
Yeah, and I think that happens a lot of the time in some especially when things change. But again, that brings it into the scope of the conversation. This idea of this time is different, and that I guess the trope is that that's always a mistake to say that. But then again, to some extent, it's always partially right too.
Yeah, and I mean, that is again just trying to figure out who's in there and who's not. When you're looking at these expectations for a V-shaped recovery, Brett. Now I know we talk a lot about this with the Barron's survey, where you're of the opinion that it's not necessarily in their best interest to answer what they think is as
Correct.
much as what they want people to do. With this
It's a
V-shaped
marketing piece.
yeah, with the Bank of America Fund Manager survey, do you find the same item with that V-shaped recovery in terms of that these fund managers are hoping that people will not be chasing this higher so that they can find a good entry spot?
Ah, no,
We've seen it in the
you know,
past where
I
people
get you.
will talk their book down in order to try to provide a better entry
I
point.
get you. I get you. Right. I don't have any way to gauge that. I would think that the distribution for this document is small enough that people wouldn't necessarily see that, and maybe though it's gotten popular enough that there's some degree of that. I don't know. But my gut feeling is that 10% expecting a V-shaped recovery. We all have to make our decisions. Obviously, I can't answer your question with 100% conviction, but I can just tell you that my gut feeling, if I had to guess in a universe where I was suddenly going to be given access to some omniscient being who can tell me the answer, my gut feeling is that 10% probably is relatively accurate.
Yeah, yeah. I mean, certainly seems that way. Um, Now, I guess the main item from that part of the survey do you see this as a bear market rally? It's been going on for an extended period of time. Bear market rallies, in my opinion, have always seemed to be a little bit more of a parabolic run than the grinding action we've seen over the last month and a half. Have you formed an opinion on that, or are you still waiting for this to play out? You want to see how it tests up against the 200-day moving average, or
Uh,
how are you viewing this?
I mean, it doesn't look if it's a bear market rally, which it may be, and I'm even willing to bet in that direction, it doesn't have any of the characteristics that have defined that idea for me in the past. So, as on a strategy meeting call, it's the same thing. Like you can compare this to a great example, a textbook example of this kind of phenomenon would be in April of May of 2008, right after Bear and before Lehman. Right, that was the quintessential kind of bear market rally. That was a couple months up, but by the time we got to the top of that, we had the exact opposite mainstream sentiment data than what we see now. We had everybody on board in widespread surveys and options data across the board that we had this little blip of a bear market. It resulted in the Bear Stearns situation. That was taken care of. This really isn't a problem that was going to metastasize onto the general economy. We're onward and upward. We're heading to new highs. That's the sentiment. That's generally speaking in right after the 2000 top when we got to that first bump, and again in 2001 when we got those bear market rallies. Same kind of situation. The sentiment data says that the consensus opinion is that the new bull market is well underway and we're heading back higher. That is what sentiment looks like at the top of a bear market rally. In this situation, we see the exact opposite. We've seen this massive, we've seen $15 trillion surge in global equity market cap. And we still see just historic levels of bear sentiment. So that's the type of thing that in the past we have seen associated with new bull markets. That's the way the new bull markets have started. I understand there's many reasons why that doesn't make sense, and I'm not saying, hey, this is definitely a new bull market, because there's so many things that don't add up to me. But if you're just thinking in terms of the basic analytic resources I typically use, that's the overall picture. Is that this doesn't fit with the idea of a standard bear market rally. Now there has been such a level of policy response that I think massively dwarfs anything we've ever seen before by a wide margin, that maybe that's confounding that analysis, and it still is destined to flop over in some way despite the sentiment situation. I don't know. I don't have any way to analyze that because we've never seen anything like that before. But it doesn't fit the standard model that I have as far as the technicals and sentiment in a combined picture for what has marked bear market rallies in the past.
Right, and especially, I mean, you used the 2008 example where you had Bear Stearns in March, and then it wasn't until 6 months later that Lehman collapsed. So I guess if you're looking for similarities to continue to play out on that, Brett, the number one concern for investors coming in at 52% in the fund managers survey was a second wave of coronavirus. So I guess you could look at that as, we had Bear Stearns just now, and then Lehman would be coming in October or November whenever flu season creeps
Sure.
back up. So is there something that you're looking for in the summer activity that could tip you off to obviously there's going to be the coronavirus data, which we have no way of predicting. But is there any sort of market activity that would be piquing your interest that you saw similarities in between that 2008 period?
Well, this is one of the other tragedies that we have right now as analysts, because I would say the fixed income markets, but they have been, completely quarantined under Fed control at this
Yeah,
point. So I don't think that there
global
is. I said
monetary
this to somebody
control,
earlier
really.
today. Yeah, I don't think that there is an information channel that's open from the pricing function of fixed income right now to be analyzed. So, I mean, we're not going to see. I don't understand how we see spreads if corporations can sell that right onto the Fed balance sheet at this point.
Well, so I guess that could take us to, since we can't use that, the number two risk was permanently high unemployment. So, and I guess we would look at that
Right.
to factor out and playing out in the credit card companies, the banks, as we
Right.
see
But how do we
defaults.
get there?
Well, I mean, obviously, the permanently high unemployment, if people start falling behind on their bills, then that starts building up. And I guess that's going to be.
Well, but the next step would be that would have to play out as a force in end demand, right?
Right.
Like if I mean, we won't have that if just as many people want to eat out just as much, for example, when this is over. But if we've damaged, personal financial situations and household credit and household financial situations to such an extent, and also the credit system in general, that people don't want to make those choices. That it has nothing to do with the virus. They don't want to make those choices because, they don't want to spend that much, and that suppresses new hiring and doesn't let us complete the sort of V process. And so that's about duration, I think, probably.
Right. No, and I mean, that's, I guess, one of the things that we'll continue to watch. And I'm getting to a point on this here, Brett. Number three was the
Okay.
breakup of the European Union, which I know you've been concerned about that for a long time.
Yes.
We have this week the second leg of the discussion for that Euro 500 billion fund that France and Germany are starting to put together. I don't know
Super
if
important.
I don't know if you've had a close look at it, but over the weekend, a number of the northern countries were coming back: the Netherlands, Sweden, Denmark, and they're looking to switch around the terminology of that 500 billion funding program to be more loans rather than grants, which is what Germany and France are looking for. Is there anything in there that you're watching that you think could really disrupt this bounce back?
Well, I mean, if we go through another leg of the disruption in general, I think there's a fence, and we're going to fall one side or the other in terms of Europe. I feel like that's been kind of part of it. I mean, if this heals from here in a V-shaped way, then maybe this is postponed until the next crisis yet again. But I think that the whole system works either completely separate or completely together. I mean, I've made this argument a number of times, and I think that it's going to be a crisis that gets us to that decision point, and either the whole thing is going to break apart or you're going to end up with something equivalent to, in functional terms, the United States of Europe. And then you've got, the euro backed by a fiscal union as well, and then you probably have a big argument to make that becomes the global reserve currency, and then you've got, massive expansion and investment inflows, and there's all the things that would bring it together, and of course the nationalism and the want to have a really loose currency in the southern states is all the things that would break it apart. And I don't know which way we're going to go, but seeing that $500 billion rescue fund was kind of like a little seed of an idea to me that suggested a tip in the direction of United States of Europe if this crisis were to intensify. And maybe backtracking it to a loan is really the statement that there's a gradual optimism about this crisis de-escalating before they get brought to that decision point, rather than it is necessarily a message about which side of the fence they'd fall on if the crisis were to escalate far enough, if that makes sense.
Right. Okay. And then number four was fears of a systemic credit event. I think that's fair enough to say if any of the other items happen that this credit
Yeah.
event could come into play. We've seen the market nicely digest J.C. Penney's and Hertz this last Friday. So credit markets haven't really been disrupted all that much, and I guess a lot of that could be another nod, tip of the cap to the Fed. Has there been anything in credit markets that has caught your attention, or not really?
No, but I mean, I think the more important person to ask is you.
No, I mean, for me, I have not. They've been acting fantastic over the last couple of weeks, and that is even with those bankruptcies. I think a lot of them were well telegraphed. J.C. Penney's for a few years and Hertz for some time, but we haven't really seen the pickup in credit card delinquencies yet. But again, this goes back to that argument that you've been discussing with depth versus duration, and really builds off of the unemployment situation, which was the number two concern. But the one thing that's kind of sticking out to me, Brett, is I didn't see anything about China in these fears around
Kind of
what could
amazing.
disrupt this. And that I guess I don't get, considering some of the headlines that we've been seeing over the last few weeks. I don't know if you're paying attention to the NPC over the weekend, but at some point Xi Jinping mentioned that China was going to be building up their military,
Oh,
and
sure. And again today.
and again today, and that they're going to be running exercises in the South China Sea. We're just seeing here, you can see on our page at 1446, the White House press secretary Kayleigh McEnany said that President Trump believes it is hard to see how Hong Kong can remain a financial hub if China takes over. Are you surprised that none of the fund managers had this in the top four for their concerns?
Yes, I suppose. I mean, the other things there, like, so you made the point, and I agree 100%, that some of the items on this list are effectively downstream dominoes to the
Right.
things higher up on this list. But so that means, so let's say those things would be really awful, but they're linked conceptually, and the things higher on the list are pretty darn bad. So I can understand how China could get crowded out at this point, and it could end up there maybe next month. And I could also understand how people might think that there's some degree of political theater happening in an election year. But yeah, I think that there's who knows? Maybe 100 years from now, the history books will write about this exact year as being, a much more important thing in terms of the inflection in U.S. China relations than in terms of this pandemic at all.
Yeah, I mean, it really does seem like an inflection point between the two global powers. It's one of those things. At some point, people want to see who the biggest kid on the block is, and just the rhetoric that we've seen. And you never want to go in being like, oh, well, war with China is the biggest concern right here, because I don't think we're anywhere near that. But a trend's a trend, and I'm just surprised that
Yeah.
wasn't higher up in any of the concerns from these fund managers surveys. And what it tends to make me think is that there's not a lot of protection against such an event like this. Do you think it could be a little bit of boy that cried wolf, since we just got through a year in 2019 where there was constant bickering going between the two sides before a trade deal was struck in later on in the year? Do you see
I think that,
similarities in that? And that's why the
well,
fund.
I think, yeah, I think we've been desensitized to some extent because there's been so much political theater in that relationship, particularly in how it's been managed in the press. So, absolutely, I think to some extent people are desensitized. They hear a lot of dramatic things going back and forth because both sides are handling this. Our administration and their administration are handling it with a lot of maneuvering around big, grandiose threats that really have to do with smaller negotiations, and we've kind of become inured to that process, maybe.
All right. One thing to quickly add on this too, that systemic credit tail risk, that fell from 30% to 8%. So as we can see, that really fell off the radar for fund manager surveys too. But continuing on with the fund manager survey, one thing that was sticking out to me was that most investors don't expect global manufacturing PMI to rise above 50 before November. November is, of course, when we have the elections, and also the potential for a second wave. So, does it seem kind of odd that the biggest fear for the fund managers, according to
Can you tell me
surveys,
which exhibit?
uh, which exhibit? I don't have it up
Oh,
in
you don't know?
front of
Okay.
me.
Yeah, no, it's just easier when I
Yeah,
look at it.
yeah, and
So
I'll pull it up over. I just have my notes here in front of me. So,
gotcha.
basically, it talks about the macro trough. If you look on the first page, you'll be able to track it from there. And what it had was just, your basic global manufacturing PMI for expectations moving forward. And
I see it. Yeah.
most managers weren't expecting us to get back over 50, which is, of course, the
Yep.
expansion territory until November. However, that's also when we could potentially be getting a second wave. Do you find it odd? I mean, these two seem like conflicting reports. It's like they're afraid of the coronavirus second wave, but not really when you consider that they expect also the global PMI to rise back above 50 around November. Um, do you find that odd?
Yeah, I guess I get exactly what you're saying. I'm not sure how it is something that's come to exhibit itself in the data that way. I suppose that while people are afraid of the second wave, maybe I see a lot of indications that there is a fear of a second wave, but not a real belief in one.
Right. And that again, just kind of I'm really at odds with what they were looking at for the biggest fears going on to here when China's not on it, and then the coronavirus. And I agree, a second wave certainly. It just feels like that's been ingrained in everybody's thought process so much that um,
Hmm.
the
Sure.
China news is just kind of missing. And again, that's why one of the things that I'm looking for the most for the headlines from there that could impact the markets, because it just really seems like fund managers are under exposed to any sort of downturn here. So taking a look at some of the more interesting positions that we're seeing here was the most crowded trade spread as we can see long U.S. tech and growth stocks, that's 60%, and we're going to get into the sentiment trader. Um, the uh, uh, the real divergence between value and growth, which is certainly interesting. But do you have any thoughts on the long U.S. tech or growth names right here?
Um, Such as.
Well, I mean, for you personally, I know you've been playing the Nasdaq a lot more frequently when you're looking to short. So do you just think
Yeah.
that
Okay.
these U.S.
Right.
In terms of vehicles and how you're looking at things, do you see the tech and growth stocks as overpriced at this point?
So, yeah, that's a really interesting question for me. I suppose that I feel like there's going to be some second order impact from what we've gone through. I don't know how extensive it's going to be, but that second order impact is not. It would end up leading to problems even for somebody like an Amazon, even though they maybe have a long-term structural advantage through this process. I think that, or Apple. Apple's a great example to me. So you've got high-priced non-essential objects and you have a pace of growth in terms of sales that has been kind of shading along an inflection zone for some time. When you have a sudden large drop in disposable income, particularly in the developed world, um, how there gets to be no pricing in of the idea that we could see a second order characteristic, which isn't about whether or not the Apple Store is going to be open. It's just going to be about like carefree use of disposable incomes. So we haven't, I think, really priced any of that kind of second order impact into thing. It's really just been about what happens when you say that people can't aggregate in large groups and go out in public a lot. That's been really what's priced into markets in the initial crash, and we really haven't priced in sort of the next chain of, well, what happens when you immediately have 35 million people lose their jobs or whatever. Where's those hits? And I suppose that again, it may be about the hockey puck. Maybe Apple is getting to where the puck's going to be 4 quarters from now. When this is in the rearview mirror and there's an increased brand reliance or whatever it is. And I suppose with all the policy money being poured into the economy, and perhaps we ramp it even further to really boost things into the election, maybe there's all sorts of ways that I can figure it in. But I guess that I've been looking for the closure of the sort of the Dow Nasdaq gap. It's something I track each day when I look at how the markets are doing. Those two have really kind of symbolized to me sort of one end of the spectrum and the other end of the spectrum. And I'm looking as we go to reopen things for there probably to be some process where the Nasdaq starts to underperform. And today so far is, I guess, a reasonable example of that. We'll see if it carries out. I can imagine it. I think looks like the Dow is up 2.6% and the Nasdaq's up 0.3%. So that kind of phenomenon happening a little bit more regularly and characterizing maybe a period of a few weeks for the market.
All right. Some of the other replacement of money we saw. Bond allocation, it's at its highest since July 2009. No real surprise given the monetary policies that we've seen there, right? You just view this as
Well,
a
this is
can't.
in line with the 10% V shape, I
Yeah,
think.
yeah, but do you
Exactly.
basically just see this as a can't fight the Fed?
I mean, I see it as also, a traditional, like, what do I do with my money now? I mean, I want to, like, I want to get my cash back without losing it, and maybe if I get some pittance uh, on the coupon or something, but that's pretty much gone. So, yeah, I mean, I suppose that there is also maybe the bet of just here is an inflation, or I mean, sorry, a recession-resistant security, and it's a basic extrapolation of the W or U-shaped expectation.
Right, and I mean, it's certainly playing out here. And again, that's been the highest allocation of bonds since July 2009. One thing, in terms of for portfolio managers, do you think that at some point that this is going to turn into the need to push back into stocks to hit? I know in the past you've talked a lot about portfolio managers needing to have a certain allocation towards bonds versus stocks. Do you see that playing out as maybe the next leg higher for pushing the stocks just to even out those allocations?
Well, so there's the fixed weight rebalance is one feature, but I think the other feature is also just what I traditionally call like a weak-handed flat squeeze, and I think that we talked on the strategy meeting that you've got $5 trillion locked in money market funds right now, and that's another reflection of that 10% V-shape expectation and the flows into the bonds. So yeah, I think that you've got the recipe for if where's this trend? Let's look at the S&P. So where's this trend headed? If the top of it is rampant bullishness and everybody on the same side of the market and a small amount of money in money market funds, that's I think around 4,000. I mean, if we're transitioning to the idea that this suddenly is going to look like a V-shaped recovery, that all of the people who got fired are just going to be rehired by the same companies in a few weeks, and that none of the stimulus is going to be taken away. In fact, it may even be expanded into the election. You know, when that sentiment shifts and the dam breaks and that $5 trillion starts to pour out of there because people are feeling left behind by this rally, and the worst thing you can do as a long-only, equity-only fund manager is miss a bull market. That's the only fireable sin there is. It's fine if you lose money by being long when everything falls apart because everybody else is too, and that's what the fund is marketing. But if you're flat or short in a bull market as somebody who's really there to give investment returns long the market in equity securities, and you don't have a piece of it, that's the weak-handed flat idea. If you're sitting there in a whole bunch of cash, the worst thing that can happen to you is an upward crash in the market, and a whole bunch of people in that same situation can kind of cause a self-fulfilling prophecy there. So there is this idea, I think, there is the possibility, given the positioning situation, if this turns out to be a very different fundamental situation, the economy is in fact stronger than ever before too much longer, and all this policy stimulus is going to stay in the picture, and everybody has to shift in terms of their positioning. Then yeah, I mean, I think that there's a really, really dramatic possibility of that sort of that basic flat squeeze idea.
Okay, let's take a quick look at some of the inflation expectations, Brett. The dollar and euro moves over the past over the past session, and then we're going to get back into that question of who is buying the market, which I think is the big one. So basically, again, we talked about long U.S. tech and growth stocks being the dominant theme. 60% of FFS investors are saying it is the most crowded trade. Number two is long cash, which we'll get into in a second here. Number three, long gold. And number four, long the U.S. dollar here. Just building off of this, FMS inflation expectations remained at net 10% of FMS investors expecting lower global CPI in the next 12 months. They also noted that March 20th was the lowest inflation expectation since January 12th. And then the last thing that we'll talk about here is 77% of FMS investors say they expect below trend growth and inflation in the global economy over the next 12 months. This was just up 1 percentage point, while 11% of FMS investors think the global economy will experience above trend growth and below trend inflation. That was up 6% month over month. So, looking at those numbers, Brett, first starting with the positioning here, the long gold, long US dollar based around this backdrop, what do you
Mhm.
think of these two assets here?
Well, I mean, if you have long gold and long dollar in the same kind of situation, then you're dealing with a credit crunch fear, basically.
Risk off
Um,
trade, basically.
yeah, I mean, you're going to find, it's a global recessionary kind of, the dominoes are tipping over into a deflationary crisis kind of thing. There's going to be some massive policy response. I mean, the playbook would be the yen, the dollar, gold, and the VIX all kind of move together, the four horsemen of the apocalypse. Um, you know, I think that the way that we're dealing with this process at this point, I think that I suppose I'm having a harder time liking a long dollar positioning given what I'm seeing at this point. But I still think that gold is probably going to have its day.
So I'm curious because I mean this has got to be a tough reconciliation for you, and to be sure, I agree with you on gold. For the dollar, with 56% of that basket being the euro, um,
Hmm.
and obviously we know your thoughts on the euro and the European Union in general.
Hmm.
How do you reconcile a weaker dollar? Do you just feel that at some point that basket could switch potentially if things were to crack that much? Or I guess it's tough to hate the dollar and hate the EU at the same time, right? Because
Yeah, that's true. Right,
um,
I don't necessarily hate the EU. I mean, I think that I've started to see a little hints here and there about which way the cookie will crumble when the rubber meets the road, to mix a bunch of metaphors. And I feel like, there's going to be a lot of tough nationalistic talk, but I feel like we've started to see enough indications that the southern states realize that, that they would prefer to be part of this situation. So who knows? Maybe that won't happen. I feel like the northern states also realized that it would be better to stay together. But they maybe take the dive. But yeah, I mean, there's a fundamental conundrum there in terms of analysis. I just feel like we have we have started to see hints of a loss of maybe. I'm losing a little bit of faith in terms of whether or not we're going to be able to put the genie back in the bottle in the way that things are being done here
you,
with the
you
stimulus.
you think the modern monetary theory is out and about and never going to be
Well,
able
I
to be
mean, I
put
just think,
back in?
this is teaching people that there's no big deal with infinitely large deficits and infinitely vast monetization of debt. So, once you learn that lesson well enough, then once the pandemic is over, what's to say the party can't go on? And I suppose that I feel like right now, in terms of the United States, that there's maybe, especially in an election year, more of a chance of that being expanded in a number of interesting ways than there are in other places around the world.
Right, and it's gonna be interesting. Did you see Japan now has 40% of their GDP in a fiscal stimulus bill at this point? I mean, that's it's just funny money. But with all that being said, all this money being popped in, um, what do you think inflation could be the greatest threat to us moving forward here? Based around if you do see the dollar weaken a little bit and the economy start picking back up, certainly some strong housing data that could form a pretty big whip around. What are some of the things that you'd be looking for that would tip you off on that?
I really don't know. I haven't passed judgment. I suppose that if we keep the stimulus in place and we get past this crisis and we've got a stronger economy than ever, and we don't seem to have let's say, the policy discipline to put a check on all of that, then that naturally leads to that idea. And I suppose that gold would still be your kind of base way to view that in terms of the lens.
All right. So
What do you
let's
think about that? Tell me what your thoughts are there.
for for the inflation turnaround? I mean,
The
certainly.
inflation deflation debate right now in terms of if there's two scenarios in terms of how this works out, and then there's two outcomes in terms of those variables.
Well, for me, the things that I'm watching, I'm certainly watching the PPI numbers because I think that's where you're going to kind of start seeing inflation really spawned out here and a crumpling of profits in general. Just in terms of last time around, I saw a number of people talking about rises to increase in costs. Obviously, we're seeing lower prices being charged to consumers out there because that's the only way people are really able to spend right now. You're certainly seeing it on the retail side, but when I start seeing like profits being squeezed from higher input costs and lower output costs, then I start wondering how long can companies continue to go down this road before they start raising the prices. And I'm looking for anecdotally for people to come out and start saying, okay, we're going to need to raise our prices to cover some of these input costs. And when that starts happening, that's going to raise the red flag to me in terms of when we could start seeing the pass through coming through. Until we see that, it's really tough to see any sort of inflation rearing its head at this point. I think there's certainly been pockets of it, particularly on the food and energy side, on the food side, not the energy side. But if we start seeing the energy costs start moving back on the rise here, which we have been. I mean, they're still low on a historical basis, but I think that's kind of the key items that you got to keep an eye out on. And once that starts working its way into the grander economy, then that's when you're going to start seeing that money that's been put to work, that's been inflated, really start to kind of jump costs up and prices up for everybody. I think it's interesting that we haven't seen housing prices impacted at all, despite 20 million people being unemployed right now. You would think that that would get dragged down to a certain degree, but what we have right now is just kind of a pause in the housing market, and that's just an interesting aspect to me where we could start seeing the inflation really start to shine through if the economy starts recovering, we get the employment back, and then we have all that money that's just been keeping us afloat here in the housing market, and then you see those low rates on top of it where you just see housing prices really taking off, and you start factoring in all those prices for people, then you get that inflation rolling, and that could really start to rear its head pretty quickly because, like you said, Brett, it's going to be tough to drag back some of the stimulus that we've seen. We saw the Fed in 2018 do one price hike more than they probably should have, and what did that equate to? Nearly a 20% decline in the markets. So, like you said, it's tough for them to pull that out, and that's kind of what I'm looking at. Do we start seeing the economy recovering and these prices start really rising? Because we have seen the input costs continue to rise, but we haven't seen the output costs rise yet. And I'm looking at that anecdotally on the PMI numbers first and foremost as my earliest tell. Certainly any earnings calls, and definitely with a key focus on the housing market because that's such a storage of wealth for so many people that if we start seeing housing prices take off, then I think we're going to see the rest of the economy move higher with that. So that's how I'm looking at it.
I think your answer also speaks to a lot of other points besides inflation, in terms of the cycle in general. If we trace out that sort of best case economic process from here, and we don't take the stimulus back, then we start to lay the foundation for something that would be an actual cyclical downturn further out into the future. And by that I mean we've seen a very strong economy, something that had nothing to do with policy, really just something that was underneath the surface because of technology advances or whatever over the last 10 to 15 years, something that was working really well in its own right, I think, as of, say, late last year, mid last year, get taken down by an exogenous factor. And not necessarily in terms of growth, I'm just in general, the way that things were functioning. Get taken down. It wasn't, in other words, a false economy that got pricked. But we could, from this, build a false economy. And when you get these huge cyclical rollovers that contain real information in the big economic downturn, it's usually because it's tearing down something that's been built on a sort of house of cards. And we could start to put something like that in place in terms of leaving a policy response here well after it's needed, and build something as a next leg of the cycle higher that eventually becomes vulnerable to something that's a more significant and lasting downturn.
Especially with there's political ramifications through November, right, Brett? I mean, you know,
Absolutely.
and any sort of move by the Fed to pull back any of the stimulus that's in place, you could be sure that there'll be some tweets about it from the White House. So, and again, going back to the taper tantrum of with Ben Bernanke back in the spring of 2013, we know the markets don't like having their punch bowl pulled away from them. So it's definitely going to be an interesting rollout, particularly if we see the economic data hold steady. And by most accounts, everything was going great in January. I mean, we saw China over the weekend say that they would have kept their 6% target on if it wasn't for this coronavirus. And so many companies, from be it the cruise lines to the airliners, they were all seeing great action before this all hit. So
Sure.
but I guess that brings us to the $1,000,000 question then, Brett. And that is, who's been buying this market? And one of the things that I wanted to talk about first was from that fund manager survey. They noted that hedge funds have a net 34% long exposure to equity markets. This was just below the February 20, January 20 level. Now, hedge funds had increased their exposure to equities by 15% this month to that net 34%. That had been the largest month-over-month increase since June of 2018. Now, what was interesting to me on this, Brett, when you look at June of 2018, it didn't necessarily signal a big rally in the markets here.
No.
You know, we had that run up until late September, when all of a sudden we started getting that rollover in October going into the Q3 earnings season. And then, of course, that which culminated in the aggressive selling in late December. So hedge funds have definitely been a part of this move here. And then there's the argument that you brought up at the beginning, which is the smart versus dumb money and what's being put into play. And there was a great article in Barron's that was talking about the belief that a lot of people are sitting at home, getting their stimulus checks and not being able to gamble on the markets. And we've got this smaller
Or on
money.
sports.
Or bet on sports, and they've been instead looking to go in and play the stock market here. There's a few items in there that we'll get into that suggest that could be in play. Certainly some of the data that we were seeing in terms of overly optimistic from the sentiment trader data with the ROBO put call was in play here. Same could be said about option speculation and just even the SPY liquidity, looking at that, where people aren't really looking at that. They're looking at more of getting that that leveraged return through options, particularly from the smaller players. How do you see this rally and the makeup going through when you're looking at that hedge fund data, and then you start seeing people talking about the $0 commissions, the stimulus checks being put into play, and that robo ratio? How are you viewing this data?
So I think that there's a lot of different factors that are involved in this process. Well, I would push back against the idea that you can explain the entire rally away as a bunch of bored e-traders sitting at home watching Netflix and, putting $100 bets here and there in their Robinhood accounts, and that's the reason why we've seen a $15 trillion increase in market cap over the last 8 weeks. I think that I think that you can find a data point that shows that some of that's going on, and then you can have a whole lot of people who are confused and upset by what they're seeing because they're not on board the situation, and they've got models and resources and analytics that show that the market should be at 1850 or whatever, And I think that there's a process here of trying to find something you can latch onto that's going to resolve that cognitive dissonance and make you feel like you can still trust the types of frameworks and resources that you've relied upon for the last 30 years in your professional money management career. I think that there's support for a thesis like this as just a simple scapegoat, that this is all just a speculative mania by an unusual group of new market participants who don't have any idea what they're doing, and that it's all therefore going to come crashing back down to earth as soon as the fairy dust wears off or whatever. And I feel like that's become a kind of a kind of teddy bear or blankie, for a lot of people who've got long careers in the market and who have seen data that suggests that they shouldn't be buying equities during this process. But I think that it's contributed. I mean, you pointed out the ROBO ratio. The ROBO ratio is back now in red flag territory, and it's one of my favorite indicators. There's unquestionably a bunch of call options being bought by people with relatively small accounts. So that's happening too. It's only recently spiked into that territory. It doesn't explain, I think, the meat of the move, but maybe it explains a little bit of the extension. But I think that also, the rubber ducky bathtub metaphor comes back into play here. I think that looking at the market as if the only way that it can go up is if the faucet's on and the drain is plugged and there's money pouring in, and what's the source of that money, is a flawed model for looking at market pricing. So if I own one share of SPY and I'm not going to sell it because I sold everything else I got and I want to keep some exposure to the market, and so I'm not going to sell it except for 10% higher from here, and you want to buy that share of SPY, you're going to have to pay up 10% to get it. The market moves based on negotiated pricing. It doesn't move based on the weight. It's not a physics machine of how much is pushing from one side versus how much is pushing from another. The market, any security that's in a publicly traded market, prices according to where you can find a price where there's both a buyer and a seller that will meet at that point. And that price can move a lot without there being very much happening from either side. So volume is an issue, but I would say if there's a bunch of 28-year-old out-of-work service sector workers who are taking their government stimulus checks and piping them into the Robinhood accounts and speculating, there's two questions I would ask. One, what's going to seem like the obvious bet to a less experienced market participant right now? And I would say, given the fact that we've seen a historic breakdown in GDP and guidance and earnings at the same time as a huge bounce, I would think there'd be a whole lot of buying of QID or something like that, rather than just plowing it into Apple shares.
Yeah, and it's funny that you mentioned that too, Brett, because I know, just anecdotally speaking, a lot of people that I've talked to, just the basic traders, are looking for that next big pullback because they're thinking that the second wave's coming. Yeah, exactly.
I mean, that's the obvious simplistic, that's the result of any kind of quick cursory analysis by any random person who has less than a year experience in markets is going to be to look at a massive and historic short opportunity here. And there are plenty of instruments that exist today that somebody can buy long only that would short the market, particularly inverse ETFs and put options. So there's that. And I forgot what the second point was. It is, either way, the other one is, so where's the offer? If you're seeing small money come in from a lot of different points to buy, that the fact that prices are moving higher as much as they have says more about the offer pulling up than it does about the bid, right? So it says something about the pricing function of markets, that the people who own the market are not willing to sell except for incrementally higher, gapping the price higher every day and pulling back on where they're willing to sell as demand comes in. So you're not seeing a lead blanket offer on this market. Whoever owns it, they're not in a desperate pursuit of distributing what they own. And that's an important piece of information as well. And you can't blame both sides of this market on the same group of non-professional money.
Right. And I would think too, Brett, I mean, a common theme is for these bigger money market guys to really just steamroll some of the smaller money coming in, and they could see these orders being processed in. And I would think that we'd be subject to a lot more headline risk dips that just like rip back and then we rip back higher. If this was indeed the case of just, your smaller player, dumb money, Robinhood accounts really being the key driver to it, you'd see a lot more games being played, particularly around options expiration, trying to drive people out from positions than we have been. So, it is tough to see, like you said, just a bunch of people who have never traded before all of a sudden being the key driver of this rally that we've seen over the last couple of weeks.
And moving it this much, and without having to then account for the fact that they're, that the offer is not overwhelming them.
Right. I don't care how many $1,200 stimulus checks you're sending out. I mean, unless you collectively got them together to be some sort of collective hedge fund, I just
There's
don't.
Some social media platform we don't know about that's driving everything.
I just don't see it. And again, that hedge fund activity it definitely suggests that hedgies were getting back into this market here. So I do see some real buying going in. I'd probably like to see it spread out a little bit more rather than being so concentrated in top-heavy stocks right now. But
I will say, though, to pop a cherry on this piece of the discussion, that's not to say that there aren't some signs where we're starting to see some shorter-term bearish indicators in sentiment data, because we are. I mean, if you look at the 10-day put-call average overall, you look at the ROBO ratio, there's a few things that are starting to pop in there that would start to open the door for sentiment-based, at least short-term swing trades on the short side. But if you try to characterize the entire rally as just some kind of historic, mythic, speculative mania driven by the Robinhood accounts, it seems to me ludicrously far-fetched.
And to build upon that, Brett, my assumption would be, and I've seen Trend as well do this, is you continue to go after NASDAQ when you're looking to short. And Trend, similar, he's been going after the Zooms, the Shopifys, these big high flyers. Do you think that perhaps some of the bigger high flying tech names have seen a crowding from these robo players?
I mean, I talked about the Apple situation. I guess I feel like there may be some distribution from the few to the many at some point in terms of repositioning dynamic. But I don't know. At the same time, this is also a structural trend toward increasing dominance by a few gatekeeper controllers of massive market potential. So unless the FTC is gonna step in a really big way, there's some structural trends toward the kind of hyper dominance of a small number of extremely overwhelmingly powerful companies.
Yeah. And just to build on some of the numbers that we've talked about, through the weekend in May 15th, the smallest of options traders, again, there was robo traders, they'd opened a new record amount of net bullish positions, and they had used more than 45% of their total volume on buying speculative call options.
What was this from? Sorry.
This was from Sentiment Trader.
No, what was the data point?
Oh, this is just the smallest of options traders.
Okay, yeah, right, sure.
Those with 10 contracts or fewer being defined, defined here. And 45% of that total volume on buying speculative call options. This is on par with the highest level of aggressive betting in 15 years. And just looking at Jason Geppert's backtest engine, hasn't typically worked out in the S&P, as the S&P 500 has declined every time small traders got this bullish. So I guess something.
But we all remember the historic top of 2005.
Yeah.
I'm just saying, I think that definitely it biases you toward some swing trades on the short side, but doesn't necessarily mean, we're headed for 1930.
Right. Yeah, no, I'm not saying anything along those lines, but I mean, if you're just looking for holes in this economy to poke, that would certainly be it. But I think the point that I'm trying to make here is that there's real buying going in underneath this. So I myself am still more in a buy the dip mode than anything else. Certainly, I think you could get a good 100, 200 point move to the downside on the right headlines. But just the basis of what we're looking at in terms of positioning with hedge funds coming in, but a lot of speculative whipped cream on top of that Sunday, I suppose we could say. It has me looking for some shakeouts, but overall, I would be keeping a longer-term trend bias right now until we really got some negative headlines that would shake my confidence in that. How are you viewing this current tape here, market, Brett. Are you on page with that, or are you looking for something a little bit more aggressive, potentially in a rollover, or are you just kind of letting things play out and see how the headlines fall?
My heart keeps wanting to short, and my brain keeps stopping it. Is basically where I've been, and I think that and it's too bad earlier today because the Nasdaq short we put on was right on the money, and for I know some people stayed with that, and I would just continue to stay with it.
Okay,
But the
I was
Go
going to
ahead.
say, so that's a good thing. How do you reconcile the two when you're trading? Do you just keep tighter risk?
I bias toward the brain, and usually that ends up being the right decision.
Yeah.
I mean, look, this is something that matches up. And so even though it's an unprecedented, uncharted territory kind of situation on many levels, it matches up with the way that the data generally looks to me in a steady bull market trend. And I can see lots of reasons to think that that's ridiculous. And obviously, so much of it's going to come down to what happens with the virus. Well, there's a big breakdown. Something just hit. Um, so, yeah, I mean, there's stuff that we don't know here. This may be a moot conversation because there's just an extraordinary shift coming of some kind,
Speaking,
particularly in terms of the virus data. But what is this now?
yeah, I'm looking.
China. Trump Pompeo meeting at White House to discuss student researchers from China. I guess this will be a major escalation.
Let's see.
Sanctioning Chinese officials.
Well, it's up.
So stepping up what we're doing to sanction China over Hong Kong.
Yeah. So, okay. Well, this is part, from my understanding, of that Senate bill. But see, this is exactly what we're talking about. Shakeouts from these China headlines
Yeah.
could just because people um, aren't situated for that. But at the same time, too, Brett, looking for shakeouts to get some of this quote unquote dumb money out of the markets to provide some better buying opportunities. And that's kind of the backdrop I'm seeing here.
And that would be what I call the overbought and underowned playbook. And that may be the right playbook right now. It could all be upended by a major second wave of the virus. We don't know. So sentiment data is only going to take you so far in this situation because at the end of the day, if we see a massive escalation in terms of the virus, let's say it doesn't turn out to be as seasonal as we thought. Let's say we've got this, what I see is an extremely odd political revolution against masks, which I still don't understand because it's such a low cost measure to take. It really isn't that horrible to put a mask on your face. And it can have such an extraordinarily positive impact, but apparently, it's a huge political statement to never wear masks. So let's say we do that, we start to get big events going, and it doesn't turn out to be seasonal as we thought, and we see an enormous spike. That's not impossible. And if that's the case, we get right back to the conundrum we had before, which is, how much volume can the hospital ICUs take? And if it's too much, then people are going to go right back into the same place we were in late March. And, that's ultimately probably going to be the most important factor, whether or not that's the case in terms of market pricing of equities. But without that factor included, we've got the overbought and underowned playbook, which is just like you said, it's looking for headline opportunities to shake weak-handed money out on the long side, to bring in weak-handed shorts on the short side, watch for some form of technical support and play the squeeze.
Yeah. So there you have it. So we got a perfect example of what we were Brett and I have been talking about. So, Brett, we're running a little long here. So we're going to wrap this up. We'll certainly be back coming up in the next. We're planning on running this every 2 weeks, so we should be back in 2 weeks' time, and this will be a theme that we're going to watch play out. But from my money, Brett, I think both of us are of the mindset that the economic data has been positive. Reopenings still remain up for question, but certainly trending in the right direction. The question of a second wave is going to be a threat that's going to stand over the markets for the next couple of months that we want to see play out. But overall, there seems to be some real money being put to work on this trend. Definitely some loose money around the fringes on that smaller option buyers there that is going to open up opportunities in both directions. But from a longer term biasness, you probably want to stay long until something breaks or until we get a little bit further of a decline on the data on both the coronavirus side and the economic data side. And probably the most underestimated item in the markets when we look at that fund manager survey is the threat from China, whether, or a relationship with China, I should say, whether or not that's because we've been dulled because of the 2019 activity or what remains to be seen. But I think that's the basic backdrop that we're seeing in the markets today. Would you agree?
Yeah, I'd agree, except I throw in one caveat. If we start to see, and it's not impossible that we could start to see an overall sentiment data picture that starts to conform more to the picture that we tend to see at the tops of bear market rallies. It's still not impossible that 2 or 3 weeks from now, after we reopen and we get the new weak-handed interest coming back in, we start to see there's a little bit more of an offer that was going to start sitting on things, and we don't see a tremendous amount of price appreciation from here, but we do see a disproportionate healing in sentiment. Then we start to look for some more, the possibility that this starts to look a little more like a bear market rally we've been involved in. That's still very possible.
Yes.
That we could start to see this morph into that kind of picture. It just hasn't yet. It hasn't yet. It could be hit by some new change in reality, but at this point, sentiment data does not show the type of characteristics you'd see at the top of a bear market rally. It just doesn't. It could end up doing that, and we'll keep a close eye on it.
Final question for you, Brett. What would you consider would signal a rejection of this 200-day moving average in the S&P? A break back below 2880, or would you? I think you had 2875 in your morning notes. Did you?
Yeah, I just feel like that's an area where it's not just about closing at 2995.
Right.
It's about you get below it, and once you get back below it, there's the market shows you a kind of an air pocket under there. That if it really was just a speculative kind of fake move that needs to sharply revisit some lower levels, then giving it back up will be a statement, and the statement will show up in the tape. Now, this is looking relatively headline driven, but I can't pin all this on headlines right here.
Yeah.
I mean, those headlines didn't seem too dramatic to me given the context and the backdrop. As far as new information, and we are now just barely back under the 200-day. If the next thing we see over the next few minutes is the bottom just drop out of this thing today, and we close close to red in the S&P, and we've just got this huge gravestone doji sitting on the daily chart, and we are, after hours in the futures looking at 2960, 2955, then that's going to be the type of statement that people are going to, rejigger their technical analysis around. If this closes at 2995, we don't see that kind of air pocket sitting underneath it, then that's, probably got people trying to take advantage of the headlines and kind of put in place something that they hope is going to turn into the former scenario. So we'll see. It's going to be an interesting 20 minutes.
Yeah. So we'll keep an eye out. Brett and I will probably throw up our thoughts right at the end here. But hey, Brett, as per usual, always a pleasure talking to you about the markets. I know the subs definitely appreciate your insight there. So good stuff. We are taping this, so we will be posting this to thebriefing.com YouTube TV page. All of Brett and I's conversations throughout the last 2 years are on there, so definitely feel free to go back and check out any of the archives. And Brett, look forward to talking with you in 2 weeks again.
All right, perfect. Thanks, Gav.
Okay, take care.
Bye-bye.